Welcome to Chapter 6, where we're going to talk about relevant information and how to use that for special decisions as a manager. I'm going to break out the video into several different videos that focus on a background for the chapter and then each individual specific special decision process. So the first step that we need to talk about is identifying characteristics of relevant information. So what exactly do we mean by relevant information? Relevant information has two characteristics. Relevant information differs among alternatives under consideration, and it has to be future-oriented. So one means that the information needs to be different if you choose option A versus option B, and it needs to be focused on future costs or revenues. A sunk cost is a cost that's already been incurred in the past and cannot change. This is really difficult for some people to understand because it's very emotional, okay? So you think about something that's already happened in the past, and you say to yourself, okay, we purchased some stock for $25,000 in cash. It's dropped in value to $15,000. This individual really needs to buy a car but doesn't have enough cash to purchase the car. His coworker suggests he sell the stock for $15,000 and buy the new car. The purchase price of the stock, $25,000, is not relevant to the decision to purchase the car because we've already spent that and we can't recoup it. It cannot change. So the coworker tries to explain to the person that he's already taken a loss on the $25,000 original investment and its sunk loss. It shouldn't factor in whether or not he should sell the stock for $15,000. The emotional response from the coworker is, I just don't want to take the loss. But that shouldn't actually factor into your decision. Now let's talk about opportunity cost. Opportunity cost is the sacrifice that you incur in order to obtain an alternative opportunity. So what exactly does this mean? It's in our case, the opportunity cost of owning the stock is $15,000 because that's the amount that we could receive if we sell the stock, okay? Relevance is also an independent concept. Here we have a situation where a company is attempting to decide whether to add cakes or pies to its product line. Take a look at the cost information that applies to cakes and pies. Under either alternative, a new production supervisor must be hired at a cost of $25,000 per year. The cakes are distributed under a nationally advertised label and therefore requires no additional advertising. The pies are marketed under the company's own name and will require an advertising campaign. Let's see how we identify the relevant costs. If we choose cakes instead of pies, we can avoid 50 cents in material cost. See how the materials differ between the two options? That would be relevant to the decision-making process. Labor costs are the same, they do not differ, and therefore they're not relevant. The supervisor's salary is not relevant because it does not differ under the two alternatives. However, the advertising costs are relevant because a portion of it can be avoided if the company decides to make cakes rather than pies. So the advertising cost can be avoided, however the franchise fee cannot. Therefore, those are both relevant because they differ. When you're determining if a cost is relevant or not, it makes no difference whether it's a fixed or variable cost. Any given cost may be relevant in one context and irrelevant in another. So let's consider a department store that sells men's, women's, and children's clothing. The store manager's salary will not be eliminated if management decides to eliminate the store's line of children's clothing. Therefore, it's not relevant to the decision-making process. However, if the company's thinking about closing the entire store in this new context, then the manager's salary is relevant because if we close the store, it'll be eliminated. So it's different under the two options of keeping the store open or closing the store. Information doesn't need to be exact to be relevant to your decision process. There's an example of this here on the slide. It just needs to be the most useful information. It needs to be both relevant. The most useful information is both relevant and precise, However, you can use your best guess when a precise information is not available. So now we're going to introduce the concepts of differential revenue and avoidable cost. So this is just a fancy way of identifying the relevant information. Relevant revenues must be future-oriented and differ between the alternatives under consideration. So the relevant revenues are also referred to as differential revenues. That means that the revenue is different in each scenario. So going back to the clothing store example, the store's revenue would be impacted if the decision was made to eliminate the children's clothing line. The revenue would be lower as a result of the decision to stop selling children's clothing. Avoidable costs are the costs managers can eliminate by making specific choices. For example, a department manager's salary is avoidable if the department is eliminated. However, the cost of the president's salary is not avoidable because the company will need a president even if an individual department is eliminated. So avoidable costs are those costs that are relevant to the decision. In this chapter, we're going to discuss relevant costs as falling into one of 4 categories. We just went over these categories in Chapter 5. Unit level are costs that can be avoided by eliminating just one product of unit. Batch is avoided when a batch of work is eliminated. Product is if a product line is eliminated. And finally, facility costs are incurred to support the entire company, are more difficult to avoid, but some of these costs may be avoided if a product line is eliminated. Facility costs, it's very hard to be avoided, so you have to pay specific attention to those. I'm going to pause the video here before we move on to making appropriate special order decisions in our next video.